Welcome to The Explainer. Today, we're going to break down a really powerful way of thinking about investing. Look, this isn't about hot stock tips or trying to predict the market. It's about a fundamental shift in your mindset. We're going to explore how you can build what are called financial pipelines, and we'll use one of the most essential resources on Earth, water, to guide us. So let's kick things off with a simple story, one you might have heard from Rich Dad, Poor Dad. It starts with a problem we can all understand. Picture this. You've got a village, it's got everything going for it, but it's held back by one huge problem. The nearest water source is a mile away. Now, this isn't just some minor hassle. It's a daily grind that's capping the village's health, its ability to grow, its entire future. It was a problem just begging for a solution. And wherever there's a big problem, there's usually a pretty big opportunity. So two entrepreneurs, let's call them Ed and Bill, they decide to step up. The village gives them both a contract to supply water. And right here, this is the moment where their paths, and really their entire financial philosophies, just split right in two. So Ed, he goes for the direct route. He sees the problem, sees the most obvious solution, and gets to work right away. He buys a couple of buckets and starts that back-breaking work of hauling water mile after mile, all day, every day. He's literally trading his time and his sweat directly for money. And hey, it worked. He was making a living. But here's the catch. His income was completely tied to the hours he could physically work. What Ed had was a job. Bill, on the other hand, he played the long game. Instead of just grabbing some buckets and competing with Ed, he vanished. But he wasn't on vacation. He was building a system. He drafted a business plan, he went out and found investors, he hired a crew, and he spent a full year building this amazing stainless steel pipeline that connected the lake straight to the village. And this quote on the slide, man, it just nails the result. Once Bill's pipeline was up and running, he could deliver cleaner water 24/7 for 75% less than Ed. Ed's bucket-carrying business was toast, overnight. But here's the real insight, the big idea. Bill hadn't just built a water system. He had built an asset. He built a pipeline that delivered cash into his bank account, whether he was working, sleeping, or off on an island somewhere. All right, so here's our game plan for this explainer. We're going to follow Bill's journey from start to finish. We'll kick off by understanding how something like water even becomes an asset. Then we'll get into understanding what these financial pipelines actually look like today. After that, we'll cover the blueprint for building one, and finally, how you manage that sweet, sweet cash flow once it starts coming in. So that really brings up a fundamental question, right? How does something that we all think of as basically free, like water from a drinking fountain, turn into a valuable, investable commodity? Well, the secret isn't in the water itself. It's in the system someone builds to deliver it. And this is just a perfect illustration of that shift. For most of history, water was free from a public fountain. Then, one day, you walk into a 7-Eleven and bam, there it is, in a bottle, for sale. And at first, you're probably thinking, why on earth would I pay for this? But people very quickly realized they weren't just paying for water. They were paying for the delivery system, the bottle. It was convenient, it was clean, it was portable. Someone built a tiny pipeline directly to you, and a free resource exploded into a multi-billion-dollar industry. Okay, so if we want to be more like Bill and less like Ed, we've got to learn how to spot these financial pipelines out in the wild. What we're looking for are assets that, once you build them or buy them, are designed to just churn out steady, reliable streams of cash. And there are a few classic types. Public utilities are the most obvious, the companies that literally own the pipes for water, gas, and electricity. Then you've got the infrastructure companies. Think of these as the picks and shovels businesses that build and maintain all those systems. And this is super relevant today with the growing need for new kinds of water infrastructure, like desalination plants and advanced recycling facilities to deal with water scarcity. You can even be the bank by buying municipal bonds, lending money to cities so they can build their pipelines and they pay you interest. But maybe the most powerful pipelines of all are what investors call toll bridges. These are companies with such a massive competitive advantage, like a huge brand or a network that's almost impossible to replicate, that they can basically charge a toll for their services for decades to come. So once we've spotted a potential pipeline, we can't just dive in and start building. No, we need a blueprint. We've got to check the engineering, make sure it's solid and stable. In the world of investing, we call this fundamental analysis. And the absolute number one most important document in this whole process is the company's financial statement. Seriously, just like an engineer would never ever build a bridge without a detailed schematic, you should never buy a company without understanding its financials. It tells you pretty much everything you need to know about the health and the structure of that business. And when you look at that schematic, there are a handful of key numbers that tell the whole story. First up, you have income and expenses. Pretty simple. That tells you if the business is making money or losing money day to day. What's left over is the cash flow, the absolute lifeblood of the company. Then you look at its assets, all the valuable stuff it owns, and its liabilities, everything it owes. And what's really important here isn't just the numbers themselves, it's the relationship between them. Does it have enough good stuff to cover its debts, or is it teetering on a mountain of IOUs? The difference is its equity or its net worth, the real value. And finally, the credit score is like a report card on how responsibly it manages its money. And this is basically how it's all laid out. That top part, the income statement, that's like measuring the flow through your pipeline. How much money's coming in, how much is going out. The result is cash flow. The bottom part, the balance sheet, well, that's the structure of the pipeline itself. What does it own? Its assets. And what does it owe? Its liabilities. Okay, this slide right here is huge. Forget all the complicated accounting jargon for a second. For a pipeline builder, it all boils down to one simple, powerful question. Which way is the cash flowing? An asset puts money into your pocket, a liability takes money out. That's it. The whole game is to just keep acquiring assets that generate income, building your pipeline piece by piece. So we've got our blueprint. We know the pipeline's design is solid. But when's the right time to actually start construction? You wouldn't start building in the middle of a mudslide, right? You need to survey the terrain first. And that's exactly what technical analysis helps us do. Now, technical analysis doesn't care about a company's profits or its balance sheet. That was the blueprint. This is all about human psychology. It uses charts to track the collective emotions of the market, that constant push and pull between supply and demand. All it's really doing is tracking the price levels where buyers and sellers agree to make a deal, and that can reveal some pretty powerful patterns of fear and greed. And this brings us to a few key ideals you'll see on charts. Support is like a psychological floor. It's a price where a bunch of buyers tend to show up and say, yep, this is a good deal, and that buying pressure can stop the price from dropping further. Resistance is the exact opposite. It's a ceiling, a price where sellers tend to come in and take profits, creating a barrier. And a channel, well, that's just the hallway the price bounces around in between that floor and ceiling. By spotting these levels, you can make smarter, less emotional decisions about when to get in or get out. And here's a perfect example of how this plays out in the real world. In the utility sector, you see these predictable seasonal cycles all the time. In the summer, electricity demand goes way up because we're all blasting the AC. Then in the winter, natural gas demand spikes for heating. These predictable business cycles often create predictable patterns on the charts that investors can actually follow. Okay, this is the moment we've been working towards. We've found our pipeline, we've checked the blueprints, we've timed the construction perfectly. The pipeline is built. Now for the best part, managing the cash flow. It's time to open up the taps, but we also have to make sure we protect our new asset. And this slide right here gets to the heart of the whole philosophy. The bucket strategy, ED strategy, is all about capital gains. It's like buying a house, hoping to flip it for a one-time profit. Your main focus is growing your net worth. The pipeline strategy, on the other hand, is all about cash flow. It's like buying that same house, but renting it out to get a steady, recurring paycheck every month. Your focus is on generating income. So how do you open the taps? Well, the most common way is by collecting dividends. That's just the company sending you your share of the profits in cash. Simple as that. Then you can put that on steroids with something called a dividend reinvestment plan, or a DRIP. Think of it like this. You're setting your pipeline to automatically build more pipeline. It takes your dividend payments and uses them to buy more shares, which then pay you more dividends. It's a beautiful compounding machine. And for those who are a bit more advanced, you can use strategies like selling options to generate income. It's kind of like acting as an insurance company for other investors. And one last crucial thing. A pipeline needs maintenance and protection. You wouldn't build a billion-dollar oil pipeline without getting some insurance, right? Well, in investing, that insurance is called hedging. It's about making a smaller, secondary investment that's designed to protect your main investment from a big, unexpected hit. It's simply the cost of protecting your cash-flowing asset. You know, in the end, it all comes back to that simple story of Ad and Bill. The question is, are you spending your life carrying buckets, trading your time for money, or are you using your time to build a pipeline?
an asset that can take care of you long into the future. Once you grasp this framework, you can look at any investment through this lens. And that leaves us with one final thought. We've talked a lot about the original pipeline for water, but what's the next essential pipeline that our world is going to need to solve the challenges of tomorrow?